Well, hello and welcome to this live webinar with WCM Investment Management. Joining me is Ryan Quinn. Ryan is a portfolio manager at WC Investment Management and he joins me from WCM's Laguna Beach headquarters. Thanks for joining us, Ryan.
Happy to be here.
So a reminder to everyone that this is an interactive webinar, so please feel free to enter any question you might have, in the panel on your screen, and we'll come to those later in the session. WCM is the investment manager of the WCM Quality Global Growth strategy. The strategy is available in Australia for Australian investors and through a listed investment company, an exchange-traded managed fund, and an unlisted managed fund. Now, today we're talking to Ryan to learn what makes WCM Quality Global Growth strategy unique and to understand the secrets behind this phenomenal performance of the company. And just in case you don't know, I'm Peter Switzer. Ryan, thanks for joining us.
Thank you. Good to be here with everyone.
All right, mate. So for those who haven't heard of WCM before, you have a unique investment process that looks at corporate culture and the trajectory of a company's economic moat. There'll be a lot of people saying, what in the hell does that mean?
Well, we're happy people are saying that because it means we're the only ones doing it. And as long as we can be the only ones doing it, hopefully we differentiate ourselves from our peers. So what I'll say is, when the strategy was launched, we do things that are not really dissimilar to a lot of other managers. We look for high quality companies that are growing with really good management teams and a wide economic moat, and that's fine. You can find a number of managers doing that. But the differentiator that we've really identified and the thing that we've really hung our hat on is our two separate pieces. Number one is that the moat matters, but what matters more than the moat is the trajectory of that moat. Okay, if we can't find a company whose moat is expanding, then we will not purchase it. If we have a company that's moat ceases to expand and goes sort of stagnant or worse declines, that's a sell signal for us. So really watching how the moat is expanding is really a key for us. And people might say, well, what's the moat? You don't walk around a company and see a bunch of water. It's a matter of looking at the return on invested capital. What's happening to that company as it takes its cash flow and it takes its profits and reinvests it in the company? Is it showing that quarter over quarter, year over year, that it's growing and making good economic decisions? It can also simply just be sales growth. Okay, and so making sure that quarter over quarter, year over year, companies continue to perform in a growing fashion is really what we're looking for in the long term. And we do take a 5+ year time horizon when we're investing in our companies. So it's not a matter of investing around earnings cycles or product cycles. It's really a 5+ year time horizon that we try to differentiate ourselves from the Wall Street research. The second piece that we differentiate ourselves with is corporate culture. We've discovered or found that really our ability to analyze the quality of a corporate culture will help us get to that 5+ year hold period. And so there are a number of different ways that we'll do work on a company's culture, because it's not found as a line item in any of the company financials, right? So there's simple things you can see in terms of insider ownership. You can see employee turnover. You can see things that are generally characteristic of a healthy company. But we take it a step further, and we have a dedicated business culture analyst here at the firm, and all that individual does is interviews the C-suite as well as ex-employees of companies that either are on our watch list or are in our portfolio, to be able to judge whether that corporate culture is doing well. We care about sort of three things about a corporate culture. Number one, is it aligned with the business? If you're a fast-growing internet company versus a railway company, you should have very different corporate cultures, and that's fine. As long as those cultures are aligned with the actual goals of that business, then we're happy with that. The second thing is it adaptable? If your company's culture can't adapt to the growing threats or the movement of the things that go on in the marketplace, then it's going to be a failure of a company. And then the last thing we look at is corporate strength, and that comes back to the interviewing process, where we're talking to the existing executives as well as ex-employees, so that when we ask them this set of sort of 10 questions that we really identified as the core of what a corporate culture should be defined as, if everyone is saying similar things, they don't have to say the exact same thing, they don't have to use the exact same words. We're not looking for people to recite, you know, the three things that are on the wall in the main office. We want them to say from their heart the same types of things. For example, if your niece was starting at the company tomorrow at an entry-level position, what would you say to her to make her step on the path towards success within the company? Another question is something like, you know, what's something a competitor does better than you that you admire? And you get really a view into the type of leadership that you're sitting across from, depending on those answers. I can give you a quick example of a corporate culture, if that would be helpful, and as it translates into business performance.
Yeah. So
there's a favorite story we have here, that when we compare two companies, Costco and Sam's Club. Costco is the world's largest wholesale membership retailer, and Sam's Club is their #1 competitor. Both companies were born in the early 1980s. Both companies have a similar footprint in terms of square foot, but the performance of the two companies are vastly different. And so when we look at Costco, I guess I should step back. For people who don't know Costco or Sam's Club, imagine a large warehouse selling everything you can buy that you can use for your home, whether it's paper towels or soap or vitamins or things. They sell it in bulk. And by selling the subscription and selling things in bulk, they're very competitive on price. And so the way that they set up their warehouses is it's really truly a warehouse feel. You have humongous shopping carts. There's pallets everywhere and large machinery to take things down and move it around. And Sam's Club does the same thing. But why has one company outperformed the other one? We found that it's really because of the corporate culture. For example, Costco has about 12% growth on its return on invested capital, while Sam's Club is 4%. Sam's Club has around 50% turnover on an annual basis, while Costco has about 6%. When you look at the employee turnover, again, Costco really promotes from within. All of the warehouse managers, about 70% of them, at one point were either checking people out or moving boxes. So really, by incentivizing people to come up the ladder, it's really led to a better experience. And really, what it comes down to is that Costco believes that happy employees will lead to happy consumers, which will lead to positive outcomes for shareholders. And so that was one of the times we looked at it and we said, gosh, it's really a powerful thing when you get two very similar apples to apples companies where the one main difference is the corporate culture, and one is massively outperforming. I mean, Costco does 2 times the amount of sales as Sam's Club with the same type of square footage. And Costco's got a great global growth plan. They've got over 700 stores globally, and they're reaching as far into Japan and Asia as they are in Canada and the United States. And so we think that it has a really great opportunity to grow its moat by continuing to take on more subscribers, but to continue to provide that opportunity for consumers. And then secondly, by focusing on the happiness of their employees and the experience within the building, they're going to continue to outpace their peers.
I always remember the story about the founder of Costco, and his desk was just basically in amongst everybody else, and his salary was unbelievably small compared to everybody else. Sure, he got the benefit when the share price did well, but he actually did set some pretty good standards that a lot of people have respected.
Well, you hit a good point, because corporate culture really starts from it applies to everyone. It's not something that's pushed down on certain employees and doesn't apply to others. Internally here at WCM, we live and breathe our own corporate culture. We believe in one that fits our business. We protect that culture, tooth and nail. Hiring is one of the most important things we do, and it's really translating into a more of a family atmosphere around here. And by doing so, we've been able to weather good markets and poor markets because we all understand exactly the direction this company should be rowing.
Okay, Ryan, so let's have a look. Your portfolio returned over 25% in the 12 months to August 2019, outperforming the benchmark by over 13%. That's a pretty impressive number. How did you manage such a strong result in such a volatile environment without going to cash in any big way?
I'm glad you brought that up. We do target a fully invested portfolio, which means cash at less than 5% at any given time. So in addition to that, we manage a concentrated portfolio. So these are all things that would make people think, oh my gosh, there's more risk. But really, when you look at the returns, we're actually much less risky than the market. And so when you look at our portfolio, it's typically around 30 to 40 stocks from the global universe of companies. The bare minimum is 3.5 billion market cap, but typically we're in large and mega cap names by US standards. When we look at the portfolio and we're making our investments, we're really focused on downside protection. This portfolio has typically in history only collected around 70% of the market's drawdown based on its benchmark, but we've been able to capture more than 115% of the upside. So the long-term returns and even the short-term returns are better because we're working off a better capital base. So when we lose less money than the market has, we're immediately going to compound better because we've saved more of our chips. And how do we do that? The corporate culture piece is huge, and the expanding moat is also huge. We find that when markets give us volatility, when markets give businesses headwinds, the poor companies fracture and splinter, and they play a poor me card. The great companies, the ones we want in our portfolio, are on their front foot. We want them acquiring the weakest competitor that's going to add something to their business. We want them reworking their balance sheet to make sure that they're in a stronger financial position coming out of this headwind. And by keeping a concentrated portfolio, we don't have to buy and sell names all the time. In fact, we have a very low turnover portfolio. It's around 25% annually, and a little less than that actually. And about half of that turnover is really adds and trims to existing names. So when the market is giving us excellent returns in one name, we'll take tips from that winner and put it into a name that might be facing some headwinds, or maybe had a weak quarter, or something that the market has sold the stock off, and give us a little bit of a buying opportunity to bolster that position. So by constantly having competition for the best names in the portfolio, for not being too greedy, by taking winnings off the table when they're given to us and adding them to names that we still believe in that the market might misunderstand. Those are a handful of the things that have really been the ingredients of that long-term compounded returns stream that we've had in the past.
Okay, so you mentioned Costco and Sam's Club. Just run us through some other companies that have strong corporate cultures and their economic moat is growing, maybe looking at areas like consumer, technology, and healthcare.
Sure. So we do manage a growth strategy. So we are always going to be focused in the healthcare, information technology, consumer, and tech spaces. So we'll typically be overweight those positions. We'll very much be underweight things like real estate. We have very few financials, exposure, energy. So things that can be overly complicated or overly tied to say the commodity prices. We're just going to stay away from those because it's not in our wheelhouse on how we study. So as a new example of a technology name would be like Shopify. I didn't mean to say that. Shopify is an online portal that allows merchants to sell direct to consumer. They compete directly with Amazon, and the company really has been disrupting that space by taking a little bit different tack than Amazon has. When someone purchases something through Amazon will take about a 30% cut of that sale. And then they'll package it in an Amazon box, and then they'll ship it off. And that's going to be, straight out of the pocket of the merchant. Shopify will allow you, with very little, if not no, understanding of building web pages or creating a direct-to-consumer online experience. You'll be able to set up a web page, put the photos of your products up there, allow consumers to click on those products, purchase them, fulfill the sale, and then ship it out in any packaging that you want. But the beauty of Shopify is that it's an a la carte service. So you can pay for the bare bones and just and sell at Amazon as well as have your Shopify site, or you can upgrade and get some accounting services. You can get fulfillment. You can get a fancier website. And so by doing this, they've been growing leaps and bounds. They initially attacked the marketplace in the mom and pop shops that Amazon frankly was too big to care about. But then what they found was that companies like Johnson & Johnson, Levi Strauss, Gatorade, a number of other large businesses also wanted a Shopify environment because they felt like they were able to keep more of their capital that they were taking in from their consumer base, and they lost nothing by being in both Shopify and Amazon. And so the business model was great from the perspective of this disrupting something that has an existing, what we would say maybe slower growing moat, if not stagnant moat business, and it's historically something that is a winner over time. Now, when you look at the corporate culture of Shopify, it's a really unique business. Toby started selling snowboards online before he discovered this online portal opportunity that he's been growing ever since from home base in Canada. And last year alone, they did $40 billion in sales through 800,000 merchants. And the year before was only 600,000 merchants. So the company is a fast grower, and the culture is not only very much focused on growing that business as fast as possible, but really what they care about is they're maniacal about the merchant experience. They care that the people that sell through Shopify sites are delighted with their site. And through that delight, they've kept those clients and upsold them in their a la carte services. And then it's gotten the attention of the much larger, very more established businesses that we didn't really expect them to be able to do, but that's been happening. And that's why the stock is up over 150% year to date. And we've trimmed it 3 times since we've owned it early last year.
I got to say, I'm selling my new book, Join the Rich Club, on Shopify. So I know that our team have found it a pretty good experience. All right, so let's go to my next question, mate. One of the hallmarks of the strategy is downside capture. Talk us through this. A lot of people wouldn't understand what you mean by that. So explain what that means and why it's so important.
Sure. Look, everyone likes to make money, but I think everyone would agree that losing money hurts a little more than making money feels good. And so we're invested alongside our partners. We take our investor base extremely seriously. They've entrusted us with their capital, and we feel like the worst thing we can do for them is lose that money. Not to say that we don't have down days, that we don't have negative returning years, but really the goal is to protect capital. And the way you do that is by having a concentrated portfolio where you know the companies inside and out, where you know the names of all the people in the C-suite making decisions, where you can see what they've done in the past, where you have evidence of a business that is growing and has a very, very holistic view of the health of the business as well as the health of the culture. Because as I mentioned earlier, when things get volatile, if everyone knows what they should be doing during that time, it won't matter. If you have sort of a very fragmented culture where people aren't sure if they should zig or zag, then they're going to throw their hands up and underperformance will follow. So really by being in those names, that's been what has helped us preserve capital over time.
Yeah, okay. So what sectors are you overweight at the moment?
So typically healthcare and information technology currently are our largest overweights. I would say that over time, we've really taken our consumer staples exposure down some. And that's a bit of a portfolio decision based on the fact that we feel like they may not be as defensive in an economic downturn. We don't invest for the macroeconomic environment, but we are respectful of it. And we understand that the growth of our economies has been quite long in the tooth since the great financial crisis. And so we're trying to make sure that we have a good mix of companies that are sort of defensive growth, that are cyclical growth, that are tied more to the macroeconomic environment, and then secular growth that are going to really keep us up as the market rises. Shopify is a very good example of a secular growth, a growth name there.
Okay, now we're now open for questions, and I've got a couple of early ones in, and this one here, a lot of people are interested in this. What are your thoughts on Alphabet, the parent of Google? Why don't you hold it in your portfolio?
Yeah, look, there are great companies in the universe of all stocks. Certainly, Alphabet, Google, it's an everyday user. We use it every day in a number of different ways, from personal email to simple web searches to some other business reasons. But as I mentioned, we keep a concentrated portfolio. We have 30 to 40 companies in the portfolio, and we tend to be in companies that are more sort of picks and shovels type companies. So we don't necessarily have to have the largest search engine in the world to be part of the internet space, right? And in fact, one of our learnings from a long time ago was owning Yahoo when we should have owned Google. Because if you think about it, Yahoo had a very wide moat when Google first came out, and we thought, oh, Yahoo's a great company, and we ignored Google for too long, and then Yahoo disintegrated, and their mail became third rate or worse. Search became overtaken by Google, and so that was a learning that we had quite a long time ago about not sticking with a company that is still a good company or cheaper now, even though a new entrant has come in. So I think Google is just a name that we haven't owned in a little while. The moat is quite wide. Could it expand more? Could it double in value in 5 years? We struggle to make that case, but we can find that with other companies. When we're looking at a company like Shopify, it's a prime example of I'd much rather own something like that that is disrupting a very large sort of stagnant business in Amazon rather than just getting into Google or Alphabet. And frankly, you can get that anywhere you want, right? It's one of the largest holdings in the ETF. It's one of the largest holdings of many of our growth competitors. So we're very happy to think differently, and we're very happy to be different. We think it's valuable in client portfolios to be different than our peers.
Ryan, is there an example of a company that you might have bought because the culture actually changed?
Yeah, I mean, it's pretty frequent that we're looking at culture from a turnaround perspective. And in some cases, there are examples of companies that actually accelerate and get better because they did focus on the culture and what was going right or wrong. An example is Pernod Ricard. They're the second largest spirits company in the world. Think of spirits such as Jameson, Absolute Vodka, Chivas, Martell Cognac, Glenlivet. So a number of really very high-end spirits, and we find that overall as a business is an attractive one, right? Because in those spirits, it's not the craft company that does very well. It's really the much larger, more established labels that do very well. And so we always were interested in that from a luxury perspective. But we found that when Alex Ricard took over as CEO, I think it was around 4 years ago. He's the grandson of the founder. He focused on the company's culture, and he became very, very, very adamant about it, which piqued our interest. And what was going on was that it's a French company with both a French and U.S. presence, and they were trying to force the French cultural norms on the U.S. presence, which he found really was sort of muting the entrepreneurial spirit of the American employees that they had in America. And so by enabling a sort of a dual culture, one that is viable for France and viable for the U.S., the company began to grow its return on invested capital pretty significantly. And that was really the only change that was made. And by recognizing that, we purchased that company, and it's been part of our sort of a luxury theme that we have in our portfolio today.
I think George W. Bush once said that the French way, they don't even have a word for entrepreneur. Well, maybe Will Ferrell impersonating George W. Bush. Mate, I've heard you have talked earlier about picks and shovels companies. What do you mean by that? So,
we've mentioned a couple times that we're in tech and we're in healthcare, and a lot of people have different thoughts when those sectors come up. When you say healthcare, some people might think a biotech drug that is going through final phases of approval, and it's very risky. It's going to be a moonshot, or it's going to be a total zero. That's nowhere near where we are. And in technology, similarly, we're not in companies that are reinventing the wheel or really trying to invent a much smaller chip. We'd much rather get into the companies that are in that process, that have become invaluable in that process, and that become really so almost like an outsourced partner to the companies that are actually doing very, very well. There's countless examples of it. For example, Taiwan Semiconductor in the technology space, right? So Taiwan Semiconductor isn't the one that's innovating and making these chips smaller. They're the ones that are servicing AMD, Intel, and they're the preferred partner for all these companies. Those companies are not going away, and the demand for those chips is extremely high. So they're very, very busy by a result of the fact that their 2 or 3 largest customers are extremely busy. From a healthcare perspective, or I guess it would be maybe more consumer, but Mettler Toledo is a company that makes it makes lab equipment like pipettes and pH meters and weighing machines for the scientific community, and the scientific community includes drug makers and areas like that, but it also includes food safety and food testing, which are 2 growing areas of the marketplace. But what matters more to Mettler Toledo is that they have pricing power over their clients, because the customers they sell to, those scientists, they care more about quality and reliability than they do about price, and they're not going to shift which group of tools they're going to use based on saving $1 or $2 or however much it was. And Mettler Toledo, being a picks and shovels company, another piece of that is that they have around less than 30% market share, but every single area that they go in to win, when it's a bake-off for their business, Mettler Toledo wins 60% of the business that they go compete for. So what we're finding is that in a sleepy business that should be sort of fairly boring, our company, Mettler Toledo, is able to go out and beat up their competitors because they're hungrier, because winning matters to them. And so, winning in the pipette business, who knew? But they're growing their market share, and it's a sticky business, and it's somewhat not recession proof, but certainly their food safety isn't going anywhere, right? And the science of things is not going anywhere, and so to be able to continue to sell into that tailwind is something we're excited about.
Yeah, okay. Now we've got Tom Hickey from Contango with a question.
I just sitting off screen here, but there was a question in about why the WCM Global Growth Limited LIC is trading at a discount. It's a great question, one we've had a couple of times recently. There's a couple of points to make on that. The first point to make is that LICs in general are cyclical, and currently around 85 or 90% of LICs in Australia, particularly global listed investment companies like WQG, are trading at a discount. So that LICs do fluctuate from premiums to discounts, and that's nothing new and has happened forever with listed investment companies. The thing specific to our listed investment company, WQG, is during the initial offer a couple of years ago, there are about 90 million options that were created, and those options had a strike price of $1.10. So with those options outstanding, that created a bit of a glass ceiling on the share price there, which should have held the WQG share price under that $1.10 level. People refer to that as an options overhang. Last month, all of those options were either exercised or sort of partially underwritten. There are a few left there, but most of those options are now out of the way. So that option overhang issue is no longer an issue, and we'd expect it to take around 12 months for that sort of to wash out and to keep moving. So the only thing that will change the discount or will close the discount is if more people are buying those shares than selling them, and the only thing that we can do to address that is to jump up and down and make as much noise about WCM and how great a manager they are, and the performance of the portfolio, and make sure as many people know about this company as possible. And that's why we're doing things like this today, making a particular focus on direct investors with a partnership with Switzer and attending all of the Switzer conferences, and getting out there and making sure people are aware of the story. So that's what I'd say in response to that.
Okay. One other question, Ryan, because we are getting close to the end of time. A lot of people would wonder, And I remember listening to Jeff Bezos talking about Amazon during the dot-com crash. He said, I think we were a $100 stock, and then overnight we became a $6 stock. He said, but my company hadn't changed at all. He said, I was still selling the same CDs and books. I think that's what he probably was selling mainly in those days. So I guess with some of the great companies you've got, that sometimes you will be a victim of what the market does during crazy times. But I presume if the companies are so strong as you say, they bounce back pretty quickly. Is that your experience?
You know, the experience is that our companies are sold off less, or if not last. Number one, because we're in unique companies that aren't really very crowded with our peers, I would say. But number two, people recognize that they're a good business. So, you know, rather than sell the name initially, they tend to hold it last and try to sell it out last. And then based on the length of the downturn, however long it is, or however long that trough is, hopefully our management teams are doing very, very intelligent things that are doing, and the employees of that company are all very, you know, very much focused on their business, so that when things start to get better, or in a lot of cases people describe that as less bad, then our companies really stand out as being like in really good financial shape, little or no debt. They manage to stay flat, if not grow, through that period. And that really piques the interest of a lot of other investors, and they come running in.
Yeah, great. All right, well, that's the end of our webinar. Ryan, we thank you for joining us. I've just got a few little other things I want to say. So if you'd like to learn more about how Aussies investors can gain access to WCM's Quality Global Growth strategy, you can contact Contango via invest@contango.com.au or via phone on 1300 001 750, and the website is www.contango.com.au/WCM. I'm Peter Switzer. Thanks for joining us.